Okay, well, welcome everybody. Welcome to our fourth webinar. I'm Danielle Woods, obviously. I'm one of our co-founders, as are the other three lovely people here with me. And you can learn more about us on our website if you don't know who we are yet. For compliance purposes, we're going to start with our little intro statement that reads, I want to remind you that our firm is regulated by federal law under the Investment Advisors Act of 1940. We are not broker-dealers, which means we cannot work for commission, nor do we sell products. We are held to a fiduciary standard, which means that we are legally required to prioritize your needs ahead of our own. And this webinar is educational and general in nature and does not constitute investment advice. We believe that investment advice is very specific to the individual and their situation, so please discuss your needs directly with one of our advisors. Get back to where I can see what I'm doing. All right. So this is our fourth one. Like we said, the last three, we've sort of been focusing on different facets of the market, tax law, estate planning, that sort of thing. And for this one, we decided to just invite you into the conversations that we've been having for several months now, just about our process, how we think about the economy and all the things that are going on. Give you guys a chance to give us some feedback and ask questions. It's helpful to us to hear things from your perspective. Obviously, we've been doing this a while, so our perspective is different than yours. So we gave it a fun name. We said, don't call it a comeback. It's a discussion about investing in our reopened economy. And we want to sort of focus on four main points, I guess, things that you hear about in the news. The first is about the Fed. Can you slide down to the next page, please? Oh, sorry, our website. Go back up. Let me back up a second. I apologize. If you haven't already, we always, I don't do anything. I think Amanda does all the work to get these webinars ready to post on our website. So you can always go back and watch them, any that you've missed or any that you thought were particularly riveting and you want to see it again. By all means, go ahead and go on there and watch it there. You can also share it with your friends or relatives or anybody you think that might benefit from it. Again, this is all general advice, so it is helpful to pretty much anybody. So we hope that you find that useful. And now we can go to the next slide, which gives you just a short summary of what we're going to talk about. David's been reading a book, and that made him want to share some of that historical insight and just the Fed is in the news a lot, and we hear that word, but we don't necessarily know what it means and what's going on with interest rates. So David is going to focus some of his discussion on that, which automatically leads to inflation. You can't talk about the Fed and interest rates without talking about inflation. And Emily's going to share some data and some information about inflation. We felt like we had to discuss cryptocurrencies. None of us particularly like them, but we don't think that they can be ignored. And Amanda, thankfully, has taken the time to learn more about that than I have. So we let her kind of lead the discussion on cryptocurrencies, what they are, pros and cons, and that sort of thing. And lastly, we wanted to talk about the labor market. There's a lot of discussion out there about unemployment benefits and the labor market. And I wanted to kind of pull back from that and look at it from sort of a 30,000-foot view and discuss it on a more academic level and see what might actually be going on here. Are we looking at shortages necessarily, or are we looking at shifts? And that was my focus there. Hi, Erica. Any questions before we jump into talking about the Fed with David? All right, next slide.
Okay, the Fed is involved in lots of things, and there's a saying in the financial markets: "Don't fight the Fed." Whichever way it's going is really a reflection, very often, on sometimes the leadership of the economy. It's related to all these topics today. Emily's going to talk about inflation. Price stability is the phrase the Fed uses in its dual mandate, which is part of what Congress asked it to do in the Federal Reserve Act. And and inflation is very much to develop the economy as much as possible so that people that want to have a job can have a job in the economy. And Amanda is going to talk about these cryptocurrencies, which in some ways are a challenge to the centralized control of the economy and money supply, which the Fed and other central banks are involved in. I think we're ready for the next slide. The Fed has a hybrid structure. It's not purely an instrument of government at all. It's a real combination between the government and the private sector. It's also not centralized totally. It has a regional component to it, much like our federal system. And this slide talks about the key components. The Federal Open Markets Committee is the one that makes the news in setting interest rate policy. The Board of Governors in the center are those people that are appointed by the president, 7 of them. They're confirmed by the Senate. That's very much a governmental role. But the Federal Reserve banks are private banks out there. There are 12 of them, and all of their presidents attend the Open Market Committee meetings. They all speak. They're called on. They're essentially required to come and present ideas and participate. Only 5 of them at any one time have a vote. So the Board of Governors, technically, members can outvote them, but the Fed tends to operate by consensus. So that discussion element is really important. This was a Wilsonian compromise back when the Federal Reserve Act was passed. The 1907 recession was very deep. They couldn't rely on JP Morgan and private bankers to do everything necessary to bring the economy out of that. So the need for the Fed came out of those events, and they couldn't agree in Congress whether it should just be a continuation of private bankers or some governmental organization. And so Wilson, as president, actually negotiated a compromise that created this hybrid strategy, some from the private through the Federal Reserve banks, bank presidents that serve on the Open Markets Committee. This was all also happening as the gold standard was fading away, especially after World War I. It faded a lot. It continued to fade throughout the 20th century, and by the time Nixon totally took us off the connection between the dollar and gold, it was pretty well gone. But there's a lot of sentiment about gold out there still. But really, it's not a precious metal that backs banking or backs the Fed. It's the economy itself. It's the balance sheets of the banks and businesses that create the economy. That's what provides the backing to a currency and what makes it puts the Fed in a place to be very influential. The Federal Reserve Act has been amended a number of times, but the dual mandate is most clear in the 1977 amendment, where the Fed is to use its monetary and credit aggregates in its balance sheets and its relationship with the regional banks to create maximum employment. That's the labor part of the dual mandate, try to keep unemployment as low as possible. Stable prices is the other part, that's inflation. And also, there's a bit of a reference here to long-term interest rates and the stability of the financial system itself. We ran into that in the Great Recession when Lehman Brothers and other major banks were collapsing. The other part of the Fed that sometimes people miss a little bit is that it's like a big think tank. It's like a big academic institution. It hires a lot of economists with PhDs in economics, and they come up with a lot of the ideas that really run into those meetings and run into the policy of the Fed. In that respect, the Federal Reserve System is a thought leader, and we could use a few of those in today's world. And so it's actually, I think, done pretty well. It also has a relationship with the international banks. I'll mention that a little bit later when we go past the graph. This is the balance sheet. This is one of the reasons that lots of people are upset about inflation. The balance sheet of the Fed, you got assets and liabilities, they got a balance. $1 trillion back before the Great Recession. They greatly inflated the balance sheet. They increased the money supply. They stimulated the economy by this technique. And their balance sheet went up to $3 trillion over that period of time. And then as they began to worry about mortgage rates, because the Great Recession was really related to problems in the mortgage sector and mortgage-backed securities, they began to buy longer term securities to try to keep down mortgage rates. And that's when they hit that 4 billion amount there in 14 and 15. And now over on the right of your screen, you see the response even more vigorously to the pandemic and to the collapse in the economy that was related to that recently. Because that great expansion that everybody was worried about to the Great Recession up to $4 trillion didn't cause much inflation, the Fed is more aggressive and more confident about running its balance sheet up now. And they believe that any increases in inflation are going to be temporary, not a permanent thing, because they essentially have more credibility, they have more power, and they're working in concert with the international banks. If you add the balance sheets of the four major international central banks, Europe, the Bank of Japan, and increasingly they call it the People's Bank of China. We're talking about communist China. Those add up to $30 trillion when you add them all together. And the European Central Bank, their balance sheet is 60% of their GDP. In the United States and in China, that's only about 34. The sheet is at 130% of GDP, is even higher than the stimulus relative to the economy here in the United States. That's a really key point. We got a final slide here on short-term interest rates. That's mostly what the Fed does, is set the Fed fund rate.
I'm sorry, David, can we go back to the slide one more time? I'm going to have a question. So we talked about this a little bit the other day, and you mentioned that they kind of kept it elevated because it wasn't impacting interest rates. But from that period from 2013 until it started to taper a little bit in 2018, what was the reason to keep it so high when in hindsight we think of that as the bull market?
Well, that taper that you can see in the graph there in 2018, where it went from over 4 trillion to under 4 trillion, was as they begin to let those longer term securities and mortgage backs taper off, they called it. In other words, when they matured or when the interest came in on them, they didn't reinvest that. And so the Fed balance sheet began to shrink. This caused a negative reaction in the stock market, a lot of concern, that the Fed was going to lose in the past. I think I just answered your question, Danielle. If there's another point you're trying to get at, why?
All right, nope, that was good. Thank you.
Okay. We want to just, and the short-term interest rates are the rates that the
Oh, looks like we lost our counterparts in New York. I'm going to go ahead and move along then. The next section I was going to talk about is inflation. So this is a big part. All right, Danielle, did you have anything you wanted to jump in with?
No, it kind of threw me there at the end there.
Yeah. So David was just finishing off about the change in interest rates, and that goes along exactly with inflation. So before we get into this a little deeper, I just wanted to point out a couple terms that we might be throwing out here and there that not everyone might have knowledge of. So the CPI is the Consumer Price Index. It's a really good measure that is part of inflation. It's basically your household goods, so your groceries, paying your bills, your utilities, what that costs today versus what it cost a year ago, 5 years ago, 10 years ago. It's a good measure to compare to see how inflation either has affected wages or to measure if wages are going up at a higher rate than inflation is. It's a very helpful economic tool. Stagflation is another one I want to point out just because it's being thrown around a little bit today with the situation, with the current inflation situation. And basically, typically inflation increases inversely, or inflation and unemployment have an inverse relationship. So inflation rises typically when unemployment is decreasing. A period of stagflation is when there's very high unemployment and inflation is also rising. And that's kind of what we're seeing. And here's a little bit of historical information here. I think it's just kind of interesting to see where we were. This is the inflation rate starting at 1907, I believe, is the first date they have. And I just pointed out a few of these peaks and valleys. That first huge drop was post-World War II deflation. The second is the Great Depression. That third, well, it's kind of a volatile period, and then a drop off is World War II and the post-World War II deflation. And then we get to this nice chunk of industrial strength in the United States here. And then the 70s, there were two huge periods of inflation, one brought on mainly by the oil embargo, so some energy sector shocks. And then the second, the Iranian Revolution, among other issues that I will mention a little bit later. So if we look at from around 1985 or so till today, there's not been a lot of fluctuation. We see obviously the Great Recession, and I'm going to zoom in on these last 20 years to show that a little bit more in detail. So the highest point was July of 2008, right before the recession, and then the low point, July 2009. So in just a year, it had dropped to -2%. And we're kind of getting to that, 5% number right now. We're currently, well, the May measurement was 4.9%. So now is the question, is it going to keep raising, or are we going to see it level off and decrease? So there's two schools of thoughts here. The high inflation scenario, do we think inflation is going to keep moving? Well, here are some arguments for reasons that it could continue to increase. And good, we've got some people coming back in. So low labor supply, and Danielle's going to get into this in her talk in more detail, but low labor supply can lead to wage increases. Second point, Americans have more money to spend right now. Since we weren't able to spend our money on the things we typically would during the pandemic, the savings rate was well over 15%. Especially at the height of the pandemic, I think it was actually up to 30%. And typically that savings rate is only about 5%. So people got money to burn, they want to get out and live their lives. But that leads to that third point, supply cannot keep up with demand, just concisely put, too much money chasing too few goods. And the final argument for continuing inflation raising is this concept of the wage price spiral. So that I have a graph on the right there. And the most common example is the 70s. People talk about this wage price spiral. So it was set off by high demand and supply shocks. So as we saw in that first historical graph, the oil embargo, as well as shocks to the food industry because of severe weather affecting agriculture, that was the main issue in 1973, in the early 70s. And then the second wave of inflation was also set off by another energy shock, another food supply shock, as well as mortgage interest rates. Those were increasing very greatly year over year in the late 70s into the early 80s. And so the shocks we're kind of seeing today are a little bit more specialized, I suppose. So we've probably been hearing about lumber and the semiconductor industry. So those are not quite shocks that are affecting the entire country. They're more just kind of affecting people a little more personally, perhaps. So let's look at the low inflation scenario. And this is a scenario that both the Fed and the current administration think is a little bit more likely. And some arguments that inflation is going to level off and eventually decrease in the near future is global competition. So US companies, they'll eventually find cheaper raw materials overseas. Even individual consumers may look overseas to find cheaper products that they used to be able to purchase domestically. Second, American workers have tended to have low bargaining power. And unfortunately, US companies tend to wait out periods of high inflation without increasing wages. Next, and this is, I think, one of the most important, the end of federal stimulus. So that's going to end in the next month or so. When government spending decreases, that's fewer dollars going into the economy. Also, forbearance programs for student loans or rent and mortgage assistance programs will likely be ending, and then consumers will have, or Americans will have to spend money on those things aside from goods and services. The final point for this low inflation scenario is that economists tend to overestimate these numbers, inflation, CPI, and GDP. This graph shows that they typically overforecast by anywhere from 0.25% to multiple percentages, as we see in first quarter of 2019. So we don't really know if inflation is going to continue to rise or if it's going to level off. Both the Fed and the current administration are trying to fight against inflation and bring it down a little, but they also don't want to do anything that's going to create more problems. So we're kind of just in this waiting it out scenario. The goal is obviously for stable inflation and a growing economy. That's what the majority of Americans, that's the scenario that's the best for most of us. So as investors, what can we do? You may have been hearing a lot about how to hedge against inflation, whether that's with gold or investing in things like cryptocurrencies. And I'm going to turn it over to Amanda to keep talking about cryptocurrencies and give us some more information there. I just pulled up this story about Tulip Mania. I read that it was being compared to the kind of Bitcoin craze over the last 5 years. So Amanda maybe will give us some insight if Bitcoin will be another speculative bubble. I can't say that. Speculative bubble. And I think hopefully she can hear us.
Yes.
Great.
Oh, okay. Is my video, I signed on my phone. I don't know why. Of course, the internet at my home crashes in the middle of a webinar. It just happens that way, right?
Yeah.
Okay, so the slides are really small, but okay, I can see. Yeah, so Emily mentioned earlier that some people were touting cryptocurrencies as a type of hedge you could use against inflation. I think in general, this was just a sales tactic, and it's not really a good way to hedge against inflation, which we can get into here more in a little bit. But on my slide here, I was originally going to talk about just cryptocurrencies, but then the whole thing with meme stocks, NFTs, if anybody has heard of NFTs, that's a non-fungible token. That's another type of thing that uses blockchain technology, which is what's behind the cryptocurrencies. And so that's what this picture is here. This was an NFT sold at Christie's for just like $69 million. So that's why I'm calling it, other shiny objects. What is the big deal here? What are people getting excited about? So just to give a little bit of background before we get too into it, one way that we generally look at the stock market and investing is to look at it as an efficient markets hypothesis. So this is probably what most of you are familiar with. You think of a company or a stock and you do some type of analysis on it, how well you think it will perform. Do they have a good product? Do they have a good customer base? Can they grow? And you can use fundamental analysis, look at their financials and determine what you think the stock should be worth. Another type of analysis you could do is technical analysis. So this is also using, math. It looks more at trends across the board, what's the new trend, what's selling now, how is the price moving, what's flowing in and out. It's more of a broad picture thing rather than an individual stock thing, but a lot of people use those types of analysis to buy and sell stocks. And another framework that people use in this when investing in the stock market is behavioral finance. In this point of view, you think of investors not using this analytical framework to make their decisions, but really investors are making emotional based decisions like FOMO, or fear of missing out, which of this behavioral finance comes into play a lot with crypto and with meme stocks.
Yeah, I think another way to talk about that, Amanda, would just be get rich quick.
Yes, exactly. And so here on this slide, you can see some of the different factors that come up with these different types of analysis. And so this is just a chart showing over the past year how these factors have worked or not worked as far as returns in the stock market. So you can see the green ones, the dark green ones have given the best returns. That's volatility, trade activity. These generally reflect higher risk factors. So you would expect a larger return from the higher risk. So that makes sense. But what I mostly want to put on here is profitability as a factor gave a large negative return. So it does look like over the past year, the fundamental analysis looking at the fundamental financials of a company has not really been paying off. This is just the past year. That's not long term.
You know what I wonder? I wonder if you go back to that other chart, why is it value stocks, which are not cheap or rich stocks, they're expected to be companies. We often think of value stocks as large companies that pay dividends, which would fall into the profitability category. I wonder why we have so much value, but we also have such a negative amount of profitability. I wonder how that reconciles. I don't know if anybody has any thoughts on that.
Yeah, I thought about that. I'm not sure. I pulled these numbers from Schwab.
You know what I bet it is? Now that I'm thinking about it, values had a really good 4 months out of the last 12 months, and the profitability was a much bigger driving issue for the previous 6 to 9 months. I think that makes sense. If you average them out, perhaps that's how it worked.
I think because the past value did really good year to date. You can see year to date it's 8.4. Also 12 months, 8.4.
Right,
so
it did nothing last year.
Nothing. Right, exactly.
Right. Okay, I just
so it's a
answered
very
your question.
recent spike. Yes. Okay, so next, cryptocurrencies. This is me with laser eyes. This is a thing, if you've been on Twitter or other social media sites, this is what people are doing to their profile pictures if they're really into crypto. So, what Tom Brady recently changed his profile picture to laser eyes.
That can be your Halloween costume, Amanda.
Yeah, maybe. So I'm not really that into crypto, but I do follow it. I do think parts of it are really interesting. I have a science background, and the blockchain technology I think is interesting. And there is some value to cryptocurrency as far as privacy concerns, and especially in countries that are less free than our own, and it's become a big thing, like in China. The protesters in Hong Kong last year were using a lot of crypto when they wanted to coordinate or exchange funds without the Chinese government being able to track them or what they were up to. So those things all have some value. But as far as the actual cryptocurrency market, a lot of it is just totally speculative and not based on this underlying value. But in the spring of 2021, the cryptocurrency market did get really big. It went up to $2 trillion And now a lot of it has really fallen off a lot since then. I don't know why, Emily, on the next slide, it's hard for me to see because I'm on my phone. It's very small, but I think it's the purple line is the price of Bitcoin. So you can just see the trade activity in orange. It was very active. And then when the price started to fall off, the activity went down a lot. And the next graph is, I think, Ethereum, which shows a similar trend. Ethereum is another cryptocurrency that's very popular. There are, I think, more than 6,000 different cryptocurrencies out there. So Bitcoin and Ethereum are two of the really big ones. A lot of the other ones are just straight fraudulent. So if this is something you are interested in, I would advise you to do a lot of research before you put any money in it. And then next, I just wanted to touch on meme stocks. Okay, so you can see here, this is just a Google trend search. So meme stocks got popular in January of 2021. If you recall, that was the whole GameStop thing where sort of day traders made a bunch of money, hedge funds lost some money. I'm sure plenty of day traders lost a lot of money too, but that's not really reported as much in the papers. That's the fear of missing out thing that, really starts to take off when it's in the news and you see those types of headlines. But then, we thought sort of the meme stock thing was over, but, it's reared its head again. So Bitcoin price fell off and now what's back? You can see people are back to searching meme stocks. So I know AMC has been a big one recently. In the next slide, I just wanted to show here, these day traders or retail investors. Retail investors is just people not using a financial professional. So their share in the market has really grown in this decade. You can see the amount of trading activity has increased by billions of dollars. If you look at the next slide, you can see the trading volume has grown from about 10% of all trades to 24% this past year. So this trend started, before COVID with the Robinhood app and that type of thing. But then the COVID lockdowns increased by a lot. But this trend has been happening for a while. And then I think the next slide you can see just compared to institutional or professional investors, mutual funds, hedge funds, that type of thing. The retail trading has really grown and takes up a large percentage of the trading we see in the market today. So, which is fine. I do think a lot of professional investors, are very critical of this trend. And I say people, they don't know what they're doing. They're just going to lose all their money. They do. Here's a survey that was in Financial Times recently saying they just look at social media and that's how they make decisions. And, that is true for a large percentage of people. I hope people doing this kind of, independent trading on their own are hopefully learning something and not trading too much of their retirement savings away, because this can be a very dangerous game to play if you don't know what you're doing. But I think the quote on the next page sums it up pretty well. It is how I think of it. This seems to be, the trend got bigger during COVID, but it's also, I think, here to stay, especially with trade fees as low as they are. It makes it easier for everyone to get in on the stock market. And for us to do is to not just criticize people, but say, okay, this is a new thing. It's going to cause some volatility in the stock market. And we can't always rely on stock fundamentals driving the prices that we see like we could in the past. So that's all the major points I wanted to cover with mine. Did anybody have any questions?
I do.
Okay.
Before we move on, I kind of wanted to wrap up the discussion with David started talking about how we switched from the gold standard to the economy standard, so to speak, and how that's impacted inflation. And then we've moved on to cryptocurrency. And I was talking to somebody recently who said, And I said, well, my concern about cryptocurrencies is not based on anything. There's no real value underneath it. And he said, well, there's no value on the US dollar either. Now, I think that's completely not the same thing at all. The US dollar is a standard around the world, but it does raise the question, why did we switch from the gold standard to begin with? And I know David's got a good answer for that. So I thought I'd throw him under the bus and have him remind us why we started doing things differently in the first place. You're on mute, David. David. There you go.
Here. Okay, I'm done talking muted. Now I'm on. It really accelerated after World War I. There's a wonderful book on that called Lords of Finance. I didn't put it up on the screen, but if anybody's interested in it, I can certainly refer you to it specifically. But most of the gold in the economy was in 4 countries going into World War I. The United States was one of them. Germany was another. So was Britain and France. After World War I, Britain, France, and Germany spent all their gold on the war. And it all moved to the United States that was selling them a lot of things during the war. And it threw it into a real lack of balance. And the central banks as they existed back then did a poor job of handling that. It helped lead to the Great Depression. Roosevelt accelerated it in his administration when he used commodity prices and studies of commodity prices in the agricultural sector to come to the conclusion that inflation could help bring you out of an economic slump. And so one of the ways you create inflation is to flood the money supply. You couldn't do that with gold. There's only so much of it. So you needed a broader money supply measure, and the Fed was able to do that. So, those were the 2 initial nails in the coffin. It's lingered around a little bit. Some people still think that it's backing our money. It's not really. It is the economy that backs the money. It is the strength of the dollar and the international trade system that makes it so strong that is backing our currency and the actions of the Fed. And balance sheets are just it. You don't have liabilities unless you have assets on the other side of the balance sheet. And it is those balance sheets and that accounting system at every level, local entrepreneurs up to the Fed that are backing the currency and creating the confidence in it that makes it work.
Thanks. That was helpful. Does anybody have any questions about all of this stuff before we move on to more stuff? Just want to make sure we're not talking over anyone.
I think the theme is coming through is that our economy is reopened and things are getting back to normal in a way, but some things are just very different than they were from before the lockdowns. And I hope that sort of point is coming across. And maybe it will once you get into the labor market, because that is still, that's definitely not back to the way it used to be, right, Danielle?
Right. And I think something that, aside from Amanda's, whose topic is completely brand new, an overarching theme in what David and Emily have discussed is that this is not the first time this has happened. There have been changes, much bigger changes than what we're dealing with now, but we all tend to remember what's right in front of us. And so I thought I'd pull up what the labor market has done for the last 20 years, roughly. This goes back to May of 2001. And those gray boxes there are that very first one all the way on the left refers to the recession that resulted after the dot-com bubble burst. And that other gray box there, obviously between 7 and 9, is the Great Recession caused by the prime mortgage crisis. And you can see the interest rates moving from there. So at the beginning of the period we're looking at, the labor market was at unemployment was at about a little over 4%. And you can see how, and it was obviously a little bit lower than that before the recession started. And recessions end even when things are still not perfect. If anything you've noticed today is economies run in cycles, and they don't always look like perfect hills or perfect valleys, obviously, but they're going to keep rolling. And so after that recession that we went through after the dot-com bubble burst, you can see that the unemployment rate continued to rise. It peaked at about 6.2 in July of 2003. So it still took a few years to get up there a little bit. And then it slowly slid back down, and it didn't really return to what it was at the beginning of our chart until 2007. So in modern terms, anyway, for those of us who've been dealing with the market for the past couple of years, that's slow. We've been used to changes happening a whole lot faster. Obviously, you can see there again that it started again with our recession that kicked off with the subprime mortgage crisis in 2008. We had a big jump up, bigger than we'd had recently in the previous, up to 10% in October of 2009. And it took a really long time for that to slide. It went 2000, we peaked at October of 2009. We got down to that low in February of 2019. So that's about 9.5 years. And I point out the 5.9% in October 2014, because that's where we are now. We're at 5.9% in May of 2021. We don't have a gray box around the current market cycle because it takes a little while for economists to decide where the start and finish is. So we definitely are in some period, or have been in some period, of recession around COVID, but there's no definitive answer about when that is yet. So you can just pretend that there's a gray box in there. And you can see that in February 2019, unemployment had reached this wonderful level of 3.5. Were you going to say something, Amanda?
Yeah. I thought you had a good break point there, but I don't mean to interrupt.
Oh, no, go ahead.
I just saw a question came in from Melissa.
I don't have it.
So I wanted to say really quick, I think she asked about the Spanish flu in 1918, if there's any similarities to those. I think I'm not sure as far as the market, because that was happening around at the same time as the World War. So I think that would have an outsized impact. I do know I've read that if you look at historical economics, what happens after several pandemics, not just the 1918 Spanish flu, but other ones that have come through, is that it's led to a general increase in the savings rate. And then once the pandemic ends, there is an increased spending, but the savings rate does stay elevated from the people who experienced the pandemic. And I think, Danielle, you're going to get into some more of that in a little bit.
Yeah, I mean, there are definitely some similarities. I didn't do like very specific comparisons. When I pulled data, there's probably something we could do. So I don't have good answers for that, but thanks for seeing it. I, for some reason, can't see that question on my chat screen, and I don't know how to fix that. So if somebody else, if one of my other teammates sees a question, please jump in and interrupt. Thanks, Melissa, for asking. So where I left off was that we reached down to a nice bottom of 3.5% unemployment in February of 2019, just in time for a pandemic to start. And we quickly shot up to almost 15% in April of 2020. And you can see again how quickly we recovered down to a number of 5.9, which is still not a nice number, but it's definitely a lot better than it was in May of 2021. And so the point of this graph is just to show you how slow some of those ebbs and flows have been in the past 20 years and how quickly this one has been. It's been pretty amazing. We expect it to continue. And some of that is technology, obviously. Having a vaccine this quickly is unbelievable. I also give a lot of credit to the American people, the American public, the government, everybody who is able to jump in, despite all the negative press we hear about all the bad things happening in the world. This is the result of a lot of good things. And I like to try to be positive and point some of that out as well. If we go to the next chart, I named my section shortages versus shifts because we see a lot of help wanted signs around, but there are areas of the economy that did quite well during COVID. So I wanted to point out this one because where we're seeing a lot of help wanted signs right now are typically low wage jobs, typically transitory jobs where people don't stay working very long. We're talking about restaurants and hotel work, people who are working. Most of us aren't working those kinds of jobs. So Amanda actually found this nice graph on Twitter one day and shared it. And I wish that I could tell you exactly what that y-axis means. I can't. I looked it up, I tried. So we're just gonna stick with the picture part of it and assume it's not perfect. But you can see that the purplish line is all major industry groups. And what it's measuring is the share of the workers in those industries who switch jobs over the course of 12 months. So that's all industries, and it's showing the movement within the labor pool in our economy at any given time. And this goes back to 2016. So it's about 5 years. And you can see how it does move around, obviously, but the blue line that follows it and jumps up and down a whole lot more is leisure and hospitality. And that's restaurants and hotels. Restaurants, hotels. I was trying to think what else that included. I guess some travel But I read the Twitter feed that came with this graph, and it really wasn't as annoying as I thought it was going to be. Some people actually had some really good insights and some comments about this, so I just listed some of those there. So why do we think that leisure and hospitality moves around more than others? Some of it's not. Some of it's a no-brainer. Low wages, obviously, people want to move up and not make more money, and that's been a tenet in our economy. People say, you know, if you don't like it, work harder or get more training and make more money. And so people have done that, and now some people are upset about it, but it happens. What's another problem with these kinds of jobs? You work nights and weekends. I don't want to work nights and weekends. And if you do work nights and weekends, daycare becomes a really big issue. Also, when you're working these kinds of hours, you usually can't get enough hours. These are typically part-time, and the hours vary by week, by month, by whoever else might be working that day. You might be brought in and sent home early if there's not enough to do. So the issue of consistency in hours is an issue. There's benefits. Typically, a lot of them don't have any retirement or anything if you're not in management, or vacation pay or time off, sick pay or anything. No opportunity for advancement. And if you do end up getting into middle management, I think that most of us agree that that's not a fun place to be either. I know some people who work in this industry, they really hate not knowing what their schedule is. Sometimes schedules are only made a week in advance. That's an issue. During COVID in particular, we saw a lot of folks who couldn't work in restaurant and hospitality because they were closed, moved to shipping and manufacturing. So Amazon was hiring like crazy. Grocery stores were hiring people to do checkout, do the virtual checkout for people coming in who didn't want to come into the store. So there was a big shift in where the labor was needed during COVID, and that's not going to recover overnight. Another one that somebody mentioned, which isn't a bad idea, again, it goes with this idea of a shift in general, is a potential shift from service to production in the United States, which I've heard people complaining about for years and years and years, and I'm one of those. Americans don't make enough of their own stuff. We're tired of bringing things in from China. Well, in order to do that, it means you're going to have less people doing things for you. You're going to have to start buying some things and doing things yourself. So I don't think that that is a bad thing, but any kind of a shift is painful for us as an economy. I like to remind folks that we're not the first ones to go through this. I always wonder what it was like during the Great Depression. That had to be horrific. You know, that's obviously a huge one. World wars had created major shifts in labor requirements, women going to factory jobs, men coming home from war and returning to those factory jobs. I think they had it a lot worse than we do. Another couple suggestions that make some sense, not that I have any data to support it, but we know that the immigration has been a major topic in this country for the last handful of years, and that there's been a lower allowance of immigrants into this country, and they tend to do a lot of those jobs. So we have less people who are willing to work for that kind of money, and there's still a fear of COVID infection. I know in the state of Tennessee, where I live, the vaccination rate is only 30%, and a lot of people don't want to go work at a restaurant making $3 an hour waiting tables with people who might get them sick. Last but not least, if you've ever worked in this area, you know that there are abusive customers. They run abound, and it's not fun to work for people making very little money and put up with that behavior. So you see a lot of comments about people who worked in restaurants and say they'll never go back. So be nice to your restaurant people if you do go out. They do have kind of a lousy job. They're very understaffed. I know I've been extra sure to be nice to people when I run my kids through a drive-through when it takes longer than usual. So that was just one thing I wanted to point out before we switch over to what is the, oh, I did a poll, I forgot. Have you ever worked in the restaurant or hotel industry for a minimum wage? I don't know, did they get it already on their screens, Amanda? There it is.
I just launched it.
Okay, Emily did it. That's great.
And we'll let it go.
So I came up with some
few
fun
minutes.
yes or no questions. Yes, but I was very young. That's all 4 of us here on the screen. Yes, you recently did, or you still do. No, you specifically avoided it for one or more of those reasons I already listed. And no, but you'd like to. And if you do, good for you, because everybody is hiring. So you have a minute to answer that, and we'll get everybody's answers in just a second.
I think that might be everyone. All right, I'm going to, yep, there we go. I'm going to end the polling here. Share
Right.
these results.
Survey says, hey, somebody wants to. That's great. So you can see here that people avoid it when they can, or they do it when they're young and they don't have any other options, and somebody out there really wants to. So I am really interested in hearing about that experience. I think a blog post would be coming for that.
All right, let's get on here. There you go.
All right, so a little chat about federal minimum wage. There's been lots of discussion about this for more than just during COVID. It was going on for a few years before. And I wanted to throw out some numbers. I went back to 1938 when they first started the federal minimum wage, which is not the same as state minimum wage. Federal minimum wage applies to federal jobs, and the states have the right to set their own minimum wage. So these numbers may not have been the same for you, but in 1938, when the first federal minimum wage came around, it was 25 cents. It's gone up steadily over the years. You can see back in 1991, 1995 area where Amanda and I were out getting our first jobs, it was $4.25 an hour for federal. I was working at White Castle. I worked nights and weekends. It was no fun. Drunk people are not happy at 3 a.m. when they believe they've messed up their food. Amanda thinks she got out of Dairy Queen with $10 an hour, so that's pretty great. David was a busboy many moons ago, and he said the waitresses were mean and wouldn't share tips with him. So he got $1.25 an hour at a local restaurant. And Emily is a little younger than us, and she was lucky enough to make $7.25 at Ace Hardware. So you can see up to 2007, it was at $5.85. The present number, that $7.25, is the same it's been since 2009. So think of all the things that have gone up in price in 12 years. And it's also the longest period of time where there's not been a raise in federal minimum wage. And maybe it doesn't surprise you as much. And I had an idea for like a little exercise, if everybody will just close their eyes for a moment and think about the worst job you have ever had, with the worst boss, wondering why on earth this person is over you. And think about that for just a minute. Remember how miserable you were, and then pretend you were making $7.25 an hour. How long do you think you would have stayed there, or what would you have been willing to do to get out of it? So it's just something to consider when people get cranky about people not going back to work at restaurants. There is good reason for it, and I do expect that there's some sort of a shift. I was also having a conversation with some family members over Father's Day. They were talking about how the local Hardee's, we have 5 of them, by the way, in my small town, 5 Hardee's, which I never go to. But they were saying that they could only do drive-through because they didn't have enough staff. And I thought, maybe one of the positive responses to this is we won't have so much fast food. I don't think that's a bad thing. Amanda was telling us last week that they were talking about the increases in heart disease during COVID, sedentary behavior. And we probably need a lot less fast food. So maybe it's a positive shift that is coming. And I know that some communities have agreed to increase the minimum wage. Emily, did you say that Chicago is going to $15 an hour next week? So there are some spots where people are changing how they're doing things. And but it's just food for thought. So next slide is about the increasing automation. I found this article in Time Magazine that was published in August of 2020. And the idea of automation is certainly not a new one. We've been talking about it for a long time. Any of us can walk into Walmart or the bank or wherever and have a machine run our transactions for us and not have to talk to a real person if we don't want to. So again, that's not a new idea. But what this article suggests is that COVID accelerated that quite a bit. And I'm one of those people who, like a lot of you, think, well, if they keep giving our jobs to robots, what are people going to do? And so I wanted to kind of pull out some good quotes out of this article, and I do recommend that you read it. It was good. The first quote that I pulled out, it's coming, is this idea that, or why it's so different now. And I just pulled out I just highlighted some thoughts, so I'm not reading the whole thing to you, but technology has always been there. New technological advances have always occurred. It's nothing new. But in the past, technology came a little bit at a time. This time it was very abrupt, or at least this period, this COVID period. And this technological life that we live is a lot of things are happening a lot faster and much more abrupt than they used to. Companies were worried about replacing workers quickly, and workers were left to their own devices to find ways of mastering new skills. Which leads me to the next quote, which talks a lot about what happens when we have those advances in technology. And my own personal concern is what happens to those workers when we replace them with robots? They have to work somewhere. And over time, this is, talking about back to 150 years ago, when we're shifting from an agrarian society to a more manufacturing to society to a more service-oriented societies, workers have always worried about those advances in technologies and that it would result in a lack of work. And it's never proved true. Even before, again, we had that number on unemployment in February of 2019, where we've had huge technological advances over the last several decades, and unemployment was only 3.5%. So technology has not created a huge amount of unemployment like some folks think. It may do that for some time, but the big periods of unemployment have tended to be responses to economic behavior, or in this case, a pandemic. It has really not had anything to do specifically with technology. That doesn't make any one person out there who's been affected by it feel any better. But as a trend goes, in general, our workers have been able to find work. The problem that we're really lacking in the United States, which comes up for the next quote, is about education and retraining folks when those changes happen. So in the past, the U.S. has responded to technological change by investing in education. And the article goes in to discuss the change from farms to non-farm work and how they expanded public schools so that kids who used to just work on farms their whole lives, they had to get educated. And so that was a new change. College was much more available after World War II under the GI Bill. 7.8 million veterans were sent to school after World War II. And then since then, U.S. investment in education has stalled. So since then, in their article, says since 1956, that's an awfully long time ago, the investment in education has been put entirely on workers. And the country now spends only 0.1% of our GDP helping workers navigate job transitions, which is less than half of what it was 30 years ago. So I would really love to hear if anybody knows about companies or communities that are doing a concerted effort toward job training. I know that there's a lot of discussion about more people getting into trades. We're meeting more and more younger folks. I think we've got 3 clients who are young electricians in their early 20s, and we're thrilled to hear about that. But if you ever come across something or hear about something about job training for older folks or anybody, most of our job training or most of our investment in this country goes to college kids. And that's not where all the need is. So I just wanted to point out those quotes. Again, I do recommend that you read the article. It's a good one. It really kind of helped me with some things that I was struggling with, and I got something out of it as well. Any questions on any of that so far? Again, I can't see.
We're coming up on an hour, so we'll stay on for a little bit. But
yeah, I'll wrap this up really fast.
Again,
And I don't want to ignore this period of time that we've been in this past year, almost 2 years, is the pandemic, and a lot of people died. So I wanted to go back. I pulled the CDC. This is total deaths in the United States back to 2013. We had about 2.6 million people passed away in 2013 from all causes. And you can see that number slowly climbs. The orange line there is the percentage change from the year before. The biggest one prior to COVID was 2014 to 2015, which was about 3.5%. Well, from 2019 to 2020, that's a preliminary number right now for 2020 at almost 3.35 or a little over 3.35 million, is a 17% increase in deaths. Now, yes, it's true that most of those deaths, the vast majority of those deaths, are older folks who aren't in the workforce anymore. But when we talk about labor, we also have to talk about behavioral behavior and how you respond to things. I think a lot of people have changed their minds about how they want to do things. If another 500,000 people died than usual, think of all the folks who would be affected if you passed away or one of your loved ones passed away. That's a lot of people out there who have been impacted by death, and that doesn't count the people who have been traumatized, who worked at ERs, who went through it with family members, people who have had COVID. They didn't pass away, but they're dealing with some lasting effects. The country is still hurting from that, and it's changed the way people think about how they want to spend their time. I want to spend 50, 60 hours a week doing something I hate. And that's always an issue. And it's something I've always raised with all of my clients. If somebody comes to me and says, well, I'm not ready to retire, I want to do this. And I just say, why? And I say, why, until they give me an answer. And sometimes it's just they're bored. They're worried about doing something else. It's not necessarily because they love what they do. And there's a big shift in that in general. I think that people in this country want to be happy. And there's nothing wrong with that. We just have to find a way to make money at it. So I want to wrap that up a little bit by saying, what we're doing as far as a group, I think that it's safe to say that we keep having these conversations. We keep watching the market. We don't make huge jumps in investments ever. We try not to be reactive. We try to be proactive. And so as far as that goes, I don't know that we've changed things a whole lot. We did make some major shifts last year. We added more to technology. We've reduced the amount in bonds because there's just no money in them. And we've had some of this discussion in our previous webinars. I'm not going to go into it any further. Do any of my other teammates have anything to add about how we feel about the current year?
I guess not.
David's thinking, I can tell. No?
We have
All
our
right.
second polling question in the meantime about how COVID has affected or changed or affected the way you think about or plan for finances.
But I mean, just building on what you said earlier, Danielle, about, you know, the deaths or trauma that people have experienced this past year, I think that does make people think about, you know, what is really important to me and what do I value? And, you know, and that ties into your personal finances. You know, do I value spending time with family? Do I value my work? What should I do? You know, and you can reevaluate what your financial goals are. And that can then affect, you know, how you save or how you spend, right?
Mm-hmm.
Yeah,
So I would
most
expect a lot of people to have rethought their financial lives this past year.
Mm-hmm. Yeah, and you pointed out earlier the savings rate. People are more, some people, I mean, obviously there's some people still struggling very much, but others are more flush with money than they've been in probably their recent memory. And, you know, what are they going to do with it? I like to think they're going to invest more, that they're going to spend more time doing things that are good for them. I like to think that they're not just going to consume, but then again, we saw what happened to Amazon during COVID. It had record sales. So, you know, there's always going to be some trends that we are disappointed with, I suppose, but there's still a lot of people out there who want to do something good with that money. And I know I get calls from folks about, hey, I think I'm ready to talk about this change. It's usually the response to something else, something that's happened to them. They've lost a loved one, or they saw a friend of theirs go through something, and they're like, hey, I hadn't thought about this until it hit home. And I think COVID hit home for a lot of people. So we've got our poll up. The biggest winner there is at 63%, is I'm saving more money and thinking more about my future, followed by I'm working harder to maintain a balance in all aspects of my life. And then a couple more are I'm spending more money and living more in the moment. And that's I do that too. And I have made or I'm planning to make a career change. I think I've always tried to be pretty balanced. I try to spend time with family and friends and travel and put a lot of work into my client work and with my teammates. So I don't know that I feel like I'm changing things a lot. The stimulus money was certainly nice. I have new walls in my son's bedrooms. That's been good. I threw up this final thoughts. Go ahead.
There was a zero there too. No, nobody said it hadn't affected.
That's
No,
true.
that's true.
The first response was it hadn't changed me at all. Nobody.
Yeah. That's a good point. So like we always say, nothing new. If you don't have a financial plan, make one. If you're changing your plans, talk to your advisor. I have folks call me after they've done things so often, and I go, gosh, I wish we talked about this first, because it does change the way we address you. Again, we do not have cookie cutter portfolios. We don't think of any of our clients as the same. We really work on each of you individually. There is no model portfolio we just plug your money into. We just had a meeting last week where we went through about a third of our clients. We discuss it as a team and we say, hey, what's going on with this person? So that if something like I'm out of pocket and somebody gets a call from someone, they know what's going on, and it gives us ideas for other clients. So we treat everybody, you all do get to be little special snowflakes at Propel. And so we run it that way. Are you nervous about the market? I've had this discussion a lot over the last 2 years. That's a good time to work with us, because your nervousness may be misplaced depending on what's going on in your life. You may not be nervous enough. Who knows? We have to have a conversation about that. Working too much. I love to tell people to stop working too much. You need to create a plan to cut back. We like to help with that. It is amazing what you can do when you put your numbers together in an organized way. I know Emily and I sat down with a client a couple of years ago, and like begged them to do a budget because they were just spending money willy-nilly. They had made money that they had never made before. And they found out that they were spending over $400 a month on Starbucks. And they were like, oh my gosh, they had no idea. So I do recommend that you actually look at the money you're spending and see if there's somewhere else you should be putting it. And back to vacation. Vacation is back. People go away. People need to go on vacation. It's essential for your mental and physical recovery. Thankfully, all four of us feel very strongly about vacation. We support one another when we go on vacation. So we do highly recommend that you do that to refresh. What else do we need to talk about? Any other questions or comments or anything else? Yeah, we want to know what you want to hear about. This one was a little different because we just kind of talked the whole time. What do you want us to tell you about or teach you about at our next webinar?
And maybe we'll be in person next time.
Yeah, we can do some in person. We can do some in-person events. We used to tell everybody before COVID, we like doing groups. So even if it's just a group of your coworkers or a group of family or a group of friends, or God, maybe we should turn it into like one of those paint your pottery nights or something, and we can talk about finances. But I think it's fair to say that people always learn something. I think we've gotten a lot of good feedback from our talking. We really enjoy what we do. We hope that came across. And part of the reason we enjoy it is because we like helping people. This stuff is stupid complicated. It's not getting any easier. And we have to keep learning right along with you. And we hope that you're getting something out of it as well.
Danielle, I think, one of the things we talked about doing was maybe some of us should kind of summarize what we thought about the four topics. We tried to present both sides, but, I think generally, I'll speak for myself, I don't want to fight with the Fed. I think the Fed is leading, and you can second guess it if you want, but you better be careful with your pocketbook when you do. I think most of us don't think inflation is going to be a serious problem beyond some temporary inflation that we're already experiencing now. I think Amanda made pretty clear we're not convinced about buying crypto. And I think Danielle's point is really a strong one. The labor market is shifting. That is telling us a lot about shifts in the economy and what's going to work in the investment world and what may not work in the future. It's not going to be the same. And looking at the labor market should be telling us that very clearly. So, that's just some conclusions. Maybe we already said those things, but I just wanted to throw that out. Maybe other guys, Danielle's often the first one to argue with me about these things. So I don't know if she has.
I thought that was great.
You what?
I thought it was good.
Yeah.
All right. People are interested in behavioral
all
finance.
over.
Yeah, they're all over. General investing strategies, behavioral finance.
Yeah, you could have chosen
all
multiple topics. So that's good to know that we try to hit on all of these at least a little bit.
I'm gonna take a picture of this so I don't lose it, because I'll lose it somehow.
And Zoom automatically saves it too.
Yeah. And when you're working with your advisor, just please keep asking questions. That's often where we get ideas for our webinars. Like, hey, this client asked me a really good question, and we end up having a big conversation about it or doing things about it. And we try to give you something that you're interested in. You don't want to hear us yammer on about something we're interested in. The whole point of these is for you to get to know us a little bit and see how we work and learn something. So thank you, Amy.
I think we can stay on if anybody has any other questions, but I hate to keep people because we've gone
yeah,
over.
Otherwise you're free to go. If anybody wants to talk, we can take you off mute if you want to talk. Just raise your hand. Thanks, Leslie. All right.
We haven't seen Leslie in a while, Danielle. You and I used to go out there and see her some.
I know. Well, maybe in a couple
Good to
weeks,
hear
when
from you,
we're,
Leslie.
or I guess it's about a month from now, we'll be sort of in that area when we will be in the Peoria area. Maybe she can come up and meet us for lunch in Peoria. All right.
Starting to storm here, so I might have to go put away some of my lawn furniture.
All right. If nobody I'm only seeing, I think, part of the chat. So if anybody else sees anything, let me know. Otherwise, we will wrap it up. See anything, Emily?
Everyone.
All right. Okay. Thanks, everybody. We will work to get this posted on our website. So if you want to watch it again, you can, or you can share it with somebody else. So thanks again. Bye.
Bye-bye.
Bye.